Okay, so picking up from where we left off at, the focus on that I want to show you now is actually what the pulse wave is. There have been questions about how to track it and why is it that sometimes the numbers change, and there were questions about the spreads, things like that. So let's address some of that here. All right, the first thing you want to note is that some of the securities, especially the ones, the pink sheets especially, they're notorious for it. The spreads can be kind of wide, and that's because for the most part they're thinly traded. There's not a lot of volume in open interest. It's just not. So liquidity is an issue. So those bid ask spreads are going to be just gigantic at times. I've seen spreads that are several dollars deep, just craziness. Okay, so just keep that in mind. That when you are, placing your trades in those type of markets, you're going to have those issues. When it comes to trading thinly traded instruments, and traditionally that means any stock that is, has less than 5 million shares traded at any given day, that's usually considered a thinly traded market. And some of these, like the ETFs, they only trade maybe, maybe 100,000 shares, in a day. So just keep that in the back of your mind that you're going to have that. So slippage can definitely be an issue. It's always better to try to enter and exit the market with stop limits in those thinly traded markets. That way you don't get gapped up on and, blown to bits per se. Because what happens is in those thinly traded markets like that, or the pink sheets, the over-the-counter markets, you know, those markets are more traditional, meaning that there's a floor broker still operating, a human being. There's still a market maker there who's setting the market, making the market, old school. So they have more power. They can do a lot of things with your ticket. Do things with your ticket that will blow your mind. So, with that said, just keep it in mind, keep it in the back of your head. That's what you're dealing with. Now, in more, more liquid assets like the SPY, which is the S&P 500 ATF, that's extremely traded all over the world. So you could have, a couple of 100 million trades going off at any given time. So you don't have to worry about that. You can enter a market order, you can enter with a stop, and you're not going to get slipped too bad. All right, you're not going to get jacked up. But you can in the thinly traded instruments. Now, as far as, want to hit another thing too with these spreads. Don't really let that concern you, because for the most part it's designed sort of like the forex brokers do. They pimp you with the spreads too, and I've done a video on that. If you want to reference that video, just go to the YouTube channel and look at how to turn 1,500 into 15,000 in less than a year. And I actually go through it and show you using ONA's platform how to actually enter your orders when it comes to the forex. In my opinion, that's the best forex broker for trading that I've ever come across, and I've traded at several, but that's my favorite one because of their order entry mechanisms. So anyway, back to this. So th these are very important columns. All right, column C and column L. That's what we're going to focus on today. Column C and column L. All right, this is your trend line resistance in column C. Likewise, column L is your trend line support. Okay, so when there's a number represented here, it means that is where your trend line resistance is. Okay, should prices get there and break that, you can expect for prices to run. All right. So yes, we do enter the market on the trend line resistance. You can also use getting tongue tied. You can also use trend line resistance to take profit as well. Okay. So trend line resistance you can use to take profit if you're already in a trade and you're riding it, but you can also use it if you're not in the trade to enter the market. For example, looking at First Majestic, ticker symbol AG. You'll notice that the pulse wave is at 1890 and so is the trend line resistance. When both of these numbers are equal like this, if prices were to break above that, it would be a big runner. That's showing you that's where the price inflection point is. The pulse wave price trigger column D, this is a complex mechanism that takes into account market depth, bid ask spreads, how deep the market is, the market depth is, where the orders are, where's the largest volume of orders, i.e. where the stops are located, things like that. So I take all that into account. All those numbers are being crunched. And it also looks at the put to call ratios, looks to see where orders are accumulating, where positions are accumulating. If there's more bullishness in the market, you'll see a big pickup in volume of calls. Likewise, if there's a big bearish outlook, then you'll see a big buildup of put buying. So all that is taken into account. I'm looking at support and resistance areas in the market, looking at key areas in the market. Just hundreds, literally hundreds of algorithms being processed in these pulse waves. These pulse waves, let's see, have been, let's see, you'll say, let's see, 294, okay, that's 10. Yeah, yeah, that's right. So 94, that's 10. 14 is 20. So 20. So 22 years in the making. I had to do the math in my head. It's been 22 years in the making to bring you these pulse waves. I have gone through blood, sweat, and tears developing this system. Uh, in multiple firms I was with when I first started back in 1994. And it's just been an amazing ride ever since. It took me almost 6 years before I could get the first prototype together and trading in the market, and that's serious. And I'm serious. 6 years. It took me 6 years from 1994 to 1999, and then in 2000 is when I was able to put my first stuff together and trade in the market with the system was in 2000. So I started the whole background research thing in 94, and for 6 years, and with me working, doing the Wall Street thing, the first firm I was at, that's when I started putting everything to use once I got the prototype done. So at the first firm I was at, marketing that prototype, the very first prototype, which was hilarious. That's where the two-bar Charlie method came out of. I had developed a system that traded just soybean futures, and the winning streak on this thing was incredible. It day traded soybeans. I'm not kidding. It would put the orders in ahead of the market open, and be out. Sometimes the trade lasts 5 minutes. I'm not kidding. It was a mechanical beast, man. And the guts of that system went into these pulse waves. So just to let you know the amount of work and research that's gone into here, it's been over 20 years in the making. This is now our 23rd year, and so this is the outcome of that labor. A few firms I worked at tried to steal this research, steal my system. They went through great lengths to try to wrestle it away from me, but that's the good thing about living in the USA. There's strong intellectual property rights and laws, and your work is your work. Once you patent and copyright and trademark stuff, it's yours, man. So that's the blessing behind it. So at any rate, that's what these pulse waves are. So once again, in column C, when there is a number represented here that is your trend line resistance, you can buy that or you can take profit at that if you've been riding the trend for some time. Likewise, in column L, this is your trend line support. There's a number here. You can use that to get short or use it as a profit target. This will be a perfect example because, as you can see, the pulse wave is at 763.45. Had you get filled there, you could ride it down to 751.63 and take profit there. All right. If you missed this, let's say you missed this first pulse wave entry point, and the next update on the sheet comes, you can get into here and get short here. And if this is broken, then of course you're looking for a big move further in that downward direction. When you see a zero into the market, and this is the key right here. The question is, how do you know whether or not a market is pulse waving? What is a positive? What does it mean when a market's pulse waving positive or pulse waving negative? What does all of that mean? Well, here it is, right here. If there is a zero in column C under your trend line resistance, or a zero in column L, your trend line support, that means the market is pulse waving. So, in our example here, in Amazon, it is pulse waving positive because the trend line resistance has a zero there. So it's pulse waving positive. Alright, likewise, First Majestic, ticker symbol AG, is pulse waving negative because we have a zero under the trend line support column. That is how we know when something's pulse waving positive or negative, because these are the readings that you will receive. It is self-explanatory, and I will go over it again, but let's say First Majestic, using that example again, today you'll be looking to go long at $18.90. If filled, your initial stop loss will be at $11.85. At the end of the trading day, after 4 p.m. Eastern Standard Time, I go into the update process. Typically, I will have the update ready by 6 p.m. Eastern Standard Time, Monday through Friday, so that you can be updated and know what you need to do for the next day. You have time to, download and study it and all that stuff. All right, so this number will change every day, and so will this number. Pretty much all the numbers may or may not change. These numbers could be static for days, only because there was no new information in the data to suggest moving that information. Maybe the trend lines have not moved. Maybe the supports and resistance levels are still the same. Maybe the market is having an inside day or something like that. There are many nuances. So here you go. I want to take time to look at this side again, your trends. I don't think I discussed 88, so I'll discuss it again. A reading of 88 with your sideways gray arrows means that the market is in a consolidation phase. It means it's trapped within the Kumo cloud of death. Yes, that's right. It means prices have finally reached inside the Kumo cloud of death. So that's what that means. All right. And of course, 70 with the golden up arrow in the uptrend column means that this market is trending. It's locked in a bullish trend. All right. And then conversely, in the downtrend, you'll see the zero there with a green light, meaning that you should refer to the bullish side of the screen, which is here. All right. Again, your bullishness. Let's see if I can make a note here. Let me see if I'll do something while I have you here. All right. This will make things a little bit better, just so you can see a little bit better and understand what's what. Let's come over here. Let's do this. All right, that's your bull side, and here's your bear side. All right, help make things a little bit clearer to you. All right, so as you know, the sell side of the screen and the bull side of the screen. It's just that simple. And actually on this side, we can just make this, where is it? Like that. Because these are your tickers. Okay, so here you are. So this is where you're at now. Helps make things a little bit easier. Okay. So this is your bull side, and this is your bear side. Okay. And that's primarily all you're doing. It's just when you're looking to buy something, you're going to look at this side of things from column B to G. When you're looking to sell short of security, you're going to be looking between columns H and M. Okay, that's all that is. That's all that means, and it makes things a little bit easier for you to see. That's why I use color codes. I like color codes because it helps to break things down so you know what you're looking at. That's all. All right, so let's move on to the next thing I want to show you. Okay, here's the 78. 78 in the momentum side is just to help you read what you're seeing. It's a consistency within this within the chart here. All right, so 78 lets you know that yes, this market is pulse waving positive, and then hence you see the zero on this side. All right, when there's a zero here, there's going to be a 78 here, unless there's a rally or rally alert or some kind of rally alert. That's when you'll see that. Okay. If there is no alert and the market is not pulse waving, then you're either going to get a 0 here or a 1. 0 and 1 is your default. A 0 means that there's nothing within the momentum reading or the alert section for this particular market. And this one right here is a futures contract. This is your feeder cattle. Just saying that there's nothing under the momentum side, and there are no alerts. Let's scroll down. Let's see if I can find another example here. Oh, here's one. Okay. Looking at Apple. All right. On the momentum side of things, there's a reading of 1. That means there's negative momentum in this market. Do you remember the chart that I did yesterday in yesterday's video? Well, if you saw where I showed you, we had the negative swing VIX versus the positive swing VIX with negative or positive momentum locked in. That's what this is here, right here. Just letting you know that you have a negative swing VIX and or you have negative momentum locking into this market. It just so happens that Apple is in the Kumo cloud. However, you have negative momentum there, so it's telling you this it should be heading down and possibly breaking below the Kumo cloud is possible. Not saying it will, just saying that it's possible. And here you have a 78. So you have negative momentum in the market, but it's pulse waving right now because you have a 78, and then you have that 0 over here. So it's definitely pulse waving. All right. And then here's your entry price here. Now that was another question. That question was, why are the entry prices sometimes so far away from the market? Well, that's a good thing. What it's telling you is you don't want to be involved on the long or short side unless that pulse wave price trigger is breached. That's what it's telling you. The system is designed to help keep you out of the market on the wrong side. So if a market's trending down, you don't want to be long. If a market is rallying, you don't want to be short. The time to buy weakness is when the weakness is over. The time to short a rally is when the rally is over. So the system is designed to get you in and out of the markets on the right side of the market. So basically, if the market is so far removed from the entry price, it is telling you basically the long side is not in play. If let's say, for instance, let's go back here, scroll back down. All right, let's use Apple again. So, all right, here's your entry price on Apple at 110.34. Let's say Apple is trading though at $89. Well, it's telling you basically that you don't have a buy in the Apple because it's too far away from the pulse wave. It's letting you know that it's not done. It hasn't found the bottom yet. Once the bottom has been reached per se, or support has been found, the pulse wave is going to automatically readjust. I designed the system to automatically do a major readjust at the end of every week. That's why they're the weekly pulse waves. I use the one sheet on Monday to trade for the entire week. That's how it works. It just so happens now that I added new mechanisms so that it can update every day, because I know the biggest question was how do you trail your stop. So this is going to help you get into the mindset to be able to do that. So I'm really excited about how that's going to pan out for a lot of you. All right. So and then last, remember the NA just means that there's not enough information, there's not enough data, long enough data, historical data for this security for me to be able to give you the uptrend information, or the it's dirty data, what I like to call it, where it may not have any volume whatsoever, and or the price may not have changed at all, so it's just not picking up a reading on it. This system really shows off with volatility, and that's really what it is. So this is the power of the pulse waves, ladies and gentlemen. The next video we will do some more we'll go into some more in depth into the traditional system aspect of approach versus the aggressive aspect, and you'll see what I mean by that in the next video. So remember, bulls make money, bears make money, and pigs get slaughtered. So take what you can, give nothing back. Human being, there's still a market maker there who's setting the market, making the market, old school. So they have more power. They can do a lot of things with your ticket. Do things with your ticket that will blow your mind. So with that said, just keep it in mind, keep it in the back of your head. That's what you're dealing with. Now, in more more liquid assets like the SPY, which is the S&P 500 ATF, that's extremely traded all over the world. So you could have a couple of 100 million trades going off at any given time. So you don't have to worry about that. You can enter a market order, you can enter with a stop, and you're not going to get slipped too bad. All right, you're not going to get jacked up. But you can in the thinly traded instruments. Now, as far as want to hit another thing too with these spreads, don't really let that concern you, because for the most part, it's designed sort of like the forex brokers do. They pimp you with the spreads too, and I've done a video on that. If you want to reference that video, just go to the YouTube channel and look at how to turn 1,500 into 15,000 in less than a year. And I actually okay, so picking up from where we left off at, the focus on that I want to show you now is actually what the pulse wave is. There have been questions about how to track it, and why is it that sometimes the numbers change, and there were questions about the spreads, things like that. So let's address some of that here. All right, the first thing you want to note is that some of the securities, especially the ones, the pink sheets especially, they're notorious for it. The spreads can be kind of wide, and that's because for the most part they're thinly traded. There's not a lot of volume in open end. The ETFs, they only trade maybe maybe 100,000 shares in a day. So just keep that in the back of your mind that you're going to have that. So slippage can definitely be an issue. It's always better to try to enter and exit the market with stop limits in those thinly traded markets. That way you don't get gapped up on and blown to bits per se. Because what happens is, in those thinly traded markets like that, or the pink sheets, the over-the-counter markets, those markets are more traditional, meaning that there's a floor broker still operating an interest. It's just not. So liquidity is an issue. So those bid-ask spreads are going to be just gigantic at times. I've seen spreads that are several dollars deep just craziness. Okay, so just keep that in mind, that when you are, placing your trades in those type of markets, you're going to have those issues. When it comes to trading thinly traded instruments, and traditionally that means any stock that is, has less than 5 million shares traded at any given day, that's usually considered a thinly traded market. And some of these, like